What are the disadvantages of a put-credit spread? Have you ever wondered about the potential downsides of using a put-credit spread in options trading? Let's break it down and see what you need to know. A put-credit spread is a strategy where you sell a put option at a higher strike price and buy another put option at a lower strike price. Both options share the same expiration date. While this strategy can be appealing, it comes with several disadvantages that traders should consider. First, let's talk about profit potential. The maximum profit you can earn from a put-credit spread is the net premium you receive when you enter the trade. Even if the stock moves significantly in your favor, your profit will not exceed this amount. This limitation means you might miss out on larger gains available through other strategies if the market moves sharply. Next, while the risk is defined, it can still be substantial compared to the potential reward. Your maximum loss is calculated as the difference between the two strike prices minus the premium you received. If the stock price falls below the lower strike price at expiration, you will incur this maximum loss. In some situations, especially with wider spreads or smaller premiums, the risk-to-reward ratio can be less favorable. Another point to consider is that put-credit spreads are directional trades. If the stock moves against your position, losses can accumulate quickly. Unlike some strategies that benefit from volatility or time decay, put-credit spreads depend on the stock staying above the lower strike price. If the stock price drops unexpectedly, you may need to manage the position or accept a loss. Time decay can also be a double-edged sword. While you benefit from the passage of time eroding the value of the options you sold, the long put you purchased will also lose value. In certain cases, the long put may decay faster than the short put, especially if it is further out of the money. This situation can reduce the effectiveness of your strategy and expose you to risks similar to a naked position if the long option becomes worthless. There is also assignment risk to think about. If the short put is assigned before expiration, you may be obligated to buy the stock at the strike price, which could be higher than the current market price. This scenario can lead to extra costs or complications, especially if you are not ready to hold the underlying stock. Transaction costs and fees can also impact your profits. Every options trade incurs commissions and fees, which can be significant, particularly for smaller accounts or frequent traders. These costs reduce the net premium you receive, making it harder to achieve a positive return. Finally, managing losing positions can be quite challenging. If the trade goes against you, you will have to decide whether to close the position early for a loss or hold it until expiration, risking the full loss. This decision-making process can be stressful and requires discipline and experience. In practical terms, put-credit spreads are best suited for traders who expect a stock to remain above a certain price and want to collect premium with limited risk. However, the disadvantages: limited profit, defined but potentially large risk, directional exposure, time decay complexities, assignment risk, transaction costs, and management challenges mean this strategy is not suitable for every market condition or trader. Understanding these factors helps traders make informed decisions about when and how to use put-credit spreads effectively.